Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront just like insurance companies do, and generate consistent returns year on year. So we want to open our brokerage platform and we want to just open any equities underlying. The one I'm currently looking at is UAL. We've got a position on UAL and we have been managing it quite aggressively, but any underlying will do, and you simply want to pull up a list of expirations for that underlying. And at this point, we want to lock in an expiration date that we can go for, and we want to be between 30 and 60 days out in time, and we also want it to be a monthly expiration, not a weekly expiration or a quarterly expiration. So looking at this list here, for equities right now, the only expiration date that fits that criteria is December 20th. So we know we're going to be 42 days out in time. Now we can take that information, come over to our watch list, and then simply filter out anything that has an earnings date within the next 42 days. And the reason for this is because we don't want earnings to disturb our trade whilst we've got contracts open. Uh, Earnings will increase volatility, it will mess up our deltas, and we don't want any of those things because it will have a negative effect on your P&L. We also want to filter out anything with a low liquidity rating level, and what you'll be left with is something that looks like this. And at this point, I simply list everything from high to low IVR. And the reason for that is because we want to sell when volatility is high. Volatility is mean reverting, and we want to sell when it's high and play the contraction. Remember, we are shorting these contracts, which means we want to be selling at a higher price and buying back at a lower price. So now we simply go down the list and just see what would fit well in our portfolio. Just keep in mind what's already in your portfolio. You can beta weight things. You can see what the correlation is to SPY. You can do all of these things, and if you have a larger portfolio, by all means, go for it. But for most people, just use common sense, and you'll be fine. If you're in a lot of tech stocks, don't look for new positions with tech. Maybe open something up with banking, agriculture, precious metals. Maybe you could look into futures. We're not going to cover futures today, but you get the idea. So the first thing that pops to mind is BOIL, which is Ultra Bloomberg Natural Gas, as it says up here. It's currently trading at $37.40. It's got a nice IV rank of 63.8, and it has an absolute IV level of 85%. So if you just pull up the chart here for BOIL, as we can see, IV has been pretty elevated all throughout. We've had a few dips here. If we bring back the highs to give us a more clearer picture of what's going on here, BOIL is not something that I trade too often. However, we are product indifferent, and it does have a nice IV rank, and it does have a nice absolute IV level. So by all means, let's have a look at BOIL. We want to go to December 20th, as we've already discussed. And this is why we don't trade BOIL, because the strike selection isn't great, if I'm being completely honest with you. And in this case, we are going to skip BOIL. We're not going to actually place any trades on BOIL for the simple reason that we can't get the deltas that we want. If we could get the deltas that we want and the strike selection was there, then by all means we would absolutely put a position on. But we're not going to be able to in this case. However, it is good to have on your watch list to keep you updated with what's going on in the broader market. It's good to have market awareness. This is something you want to have on your watch list for market awareness as opposed to trading per se. However, there can be times where it can come in useful. But we'll save that for another video. We've got Delta Airlines, GLD, Tesla. Let's just have a look at Tesla. Why not? Good old Tesla. It's trading at $314. It has been on a bit of a tear since the elections. We've got an IV rank of 58 and an absolute IV level of 63.5. So let's just have a look at Tesla here. As we mentioned, it has been going on a little bit of a rip since the elections, but then again, Tesla is also Tesla, so it does tend to do that from time to time. So again, we're going to go to the same expiration date, and this is a real life look of what I do every single day. We just simply just go through different underlyings and see what looks good. There is no, I mean, there are definitely guidelines that you can follow, but there is an element of intuition as well that just comes with time. And you simply just need to go through the list and just see what would fit well in your portfolio. So Tesla, I have a good feeling about Tesla. It's got a nice IV level of 61.9. And so this is our expected move here, the vertical orange bar. The horizontal orange bar shows you where price currently is with respect to the strikes. Very simple, as we always do. We want to sell one call, one put, and we want to sell them between 15 and 20 deltas. I think we can go with a. Let's have a look. I think we could go with an 18 delta at the 395 strike. And if you can find the same thing on the put side here, which is just on the edge of the expected move, and we've got an 18 delta on both sides, that does give us a negative 0.32 delta on the overall position, which for all intents and purposes is basically delta neutral, and that's good enough for us. This orange bar here shows you our break-even points. So our break-even points are, below 260 and above 405, just above 405. So even though our strike on the put side is just on the edge of the expected move, our break-even point is actually a couple strikes further down. So the reason for that is because our break-evens are whatever the strike is on our short contract plus or minus the premium that we collect, because the premium that we collect is non-refundable. We never need to give that out back again. No matter what happens, we keep the premium that we collect. So on this position, we would collect 1.3k up front, and our broker is going to require just under 13k in buying power, so about a 10% return on capital, which is very nice for a naked position. We've got a 72% probability of profit and an 85% chance of this position hitting 50% of max profit at some point over the next 42 days. So we are looking at some very, very high probabilities on the from the get-go. That's before we make any adjustments. That's before managing risk, any of that. So our actual win rate would be much higher. Not even including, even if you don't want to do adjustments, fear is always overstated in the market. Implied volatility is always mostly overstated in the market. So our actual win rate would just be higher. Just outright, plain and simple, would be higher than these numbers because of what we've just discussed. And then on top of that, you got adjustments and stuff. So we're looking at very, very, very high probabilities of success here. Now, not everybody has 12.6k in buying power to allocate, but you might have a couple $100. So how do we reduce the buying power requirement? Well, we've got two short contracts here. We can just simply buy another contract, or we could say going long on another contract, say a little bit further out, say $5 wide, $5 wide on the call side as well. So we've got a spread here, $5 between our short and long contracts on either side, and that's going to limit our loss. So we no longer have an unlimited loss potential. Our loss is now defined, and it is defined by the difference between the short and long contracts minus the premium that we collect up front, which is $1.60. So it's $5 minus $1.60, and that's how we end up at the max loss here. Remember, each contract controls 100 shares, so it's $1.60 times 100. It's not actually $5, it's $500. So our max profit would be, we'd collect $158 up front, and we would be able to collect our buying power requirement was going to be $345. So from whatever it was, 16, I can't remember, was it 13,000, 12,600, 12,600 down to 345. That's how you do it. You would have a slightly lower probability of profit, but you also have a higher return on capital. So that's your trade-off. By all means, you can go $10 wide, go a little bit further. Your buying power is going to be higher. your buying power requirement, is going to be higher. You will collect more premium up front, and your probability of profit will increase. But for most people, $5-10 wide is fine. $20 wide, depending maybe even on Tesla. Just depends on your portfolio and what the current VIX level is. And we're going to show you how you can put all of those things into an equation and see what comes out the other end. So with this being a covered position, you could also actually increase your delta slightly. So if you go to a 20-21 delta on both sides here, 21 delta on both sides. And what that's going to do is it's going to give us an even higher probability, higher return on capital, slightly lower probability of profit, but our loss is defined. So we don't need to worry about tail risk. We don't need to worry about CVAR as much. As you can see, CVAR is still there, but our CVAR, so let's just keep an eye on CVAR, and I want to demonstrate the point here. If we take off the longs. So there's your CVAR without the longs, and this is your CVAR with the longs. So it's a massive difference. And CVAR is basically the what you'd have to pay out in the worst 5% of cases. So essentially your tail risk. So that's how you can find positions. That's how you can manipulate positions to fit inside your portfolio. Now, how do we know how much buying power to allocate to any position? So we have a free position sizing template that's free for everyone to use. Get a copy of. Link is in the description. Just click the button here and it will take you to this spreadsheet that you can make a copy of in your own Google Drive. The way it works is you enter in the size of your portfolio up top, and then you enter in what the current VIX level is below, and then everything below that will be automatically calculated for you. And you simply just need to use this information and follow it and use it to form the backbone of your portfolio. It will tell you how much buying power to allocate to any single undefined risk position, any single defined risk position, how much of your portfolio you should allocate to short premium strategies in general. As long as you follow this, you'll be absolutely fine over the long term. If you want to learn in more detail of what we do and how we do it, again, link in description. Click on EDS Premium this time and get yourself signed up. Inside EDS Premium, you will have access to our portfolios. You can see the positions that we're placing, how we're managing risk, the adjustments that we're making, all in real time. You can use it to learn, or you can use it to copy us. It's absolutely fine. It's up to you. There is a full course inside, so no prior knowledge is required whatsoever. We will teach you everything you need to know from start to finish. And it is a private community. So if you get stuck, you can speak with other like-minded individuals, or you can speak with myself directly. There's a 100% money back guarantee. So after 6 months, if you're not happy, you're not satisfied, you don't know what you're doing, but you've been through the full course and you followed some of our trades, then at that point we will work with you for free until you do know what you're doing, or you can simply just request a full refund. So it's completely risk-free on your part. You would not need to be a member for life. However, if you wanted to, I'd be very grateful. But the goal is to teach you what you need to know within 6 to 12 months so that you can then do it for the rest of your life, completely autonomously without any outside influence. And right now to join, it is £1 a month. So the price will be increasing on this. It's just for the first couple of people that join. That's why it's so cheap. But the price will be increasing. So you definitely are rewarded for getting in early. Once you're in, the price is locked in for you. You don't need to worry about price increases. So with that being said, guys, I will see you all on the inside.